don't know when I changed. Your voice replaying in my mind. I'm not prepared this time.
Everybody, good morning. Sorry for the late start. Pretty important day today. Non-manufacturing PMI come out 30 minutes. Obviously going to be a pretty decent moving services PMI in 15, right? With those things coming up. So service is probably going to move, but the non-manufacturing is going to be something that'll give the market some jolt. We're treading on the idea that Fed's likely going to not raise rates further. That's something we said would happen around April, give or take. They've been hinting at the idea that they're going to keep pushing a little bit, but the last kind of conversations between them, they're relaxing and going to sit there and probably float at no change. Let's go ahead and skip the intro. Skip the intro here. Oops. Sorry, a late start, you guys. All right, just trying to take a look for any red line potential, or I'll take it back and jump later. Markets are rational across the board. Just read. It's about time to make some trades. See what we got here. We'll look for DD bands. So we're solid. VIX, no issues. That looks pretty good. Let's start front and center. Keep in mind, we got, like, in 15 minutes, we have an event coming through, Catalyst. Nothing coming into the news. It's really, we had a rate cut. An OPEC meeting, I think, is what we had, and a rate cut is justified inflation, as oil is practically the currency of the countries in OPEC. So obviously when inflation is high, they're gonna throttle production just to maintain the value of it. It's not necessarily bullish for the long haul. They just match inflation. They've been doing that since the 70s, so it's a pretty normal thing. Mike may be a little quiet, my bad. I had it turned down because there's ambient noise in my room. I have a space going on next to me, so if it's too quiet, let me know. All right, let's go. Front and center, bull long up, 428 support and spine. That's pretty easy to see. Resiliences are positive. Things look great. The DD number come through. Bull long up 354. So obviously, I'm going to wait for the PMIs to come out. I don't want to trade in the middle of an event. PMIs come out. I'm going to long at hedge pressure, take a long to upper, maybe gap fills if we do have them. If there ends up being a red day today, tomorrow will be a green day. There's a lot of power inside of this rally, so this is a wait before we enter. That's a pretty easy thing to see before I enter. I don't know what y'all are doing. Commander traders still over the weeks showing a positive market maker position. Market's not going to crash just yet. Liquidity forming in the futures markets. It's pretty easy to see all of that. Let's check out Russell in front and center, bull long up the same. Everything is the same, so I'll be scraping up some hedge pressure supports today. Pretty easy to see all that, so it's going to be a buy the dip sort of day. Make sure obviously I get it. So upper target on SPY today. Let's look for some gap fills, see if we can find them, or DD bands, one of the two. So inside the middle, DD band is basically it. Just showing you really quick, I have this impact red line still sitting here on NQ from, I don't know what day it's from, okay, from yesterday. So keep in mind there's going to be a resistance here. I would say that we touched that. We're likely maybe to have some effective pullback just in the PMI. I'm anticipating PMI to take down today. Just after that squeeze on Friday. I know this is just my spidey sense tingling. I'm going to trade what is, but I definitely want to get in on a dip that makes sense. Russell pulling back a little bit is showing that the run on Friday was really overbought for some of the small cap stocks, clearly. Not just something that had to do with expiration mechanics. S&P not really getting a lot of steam just yet, but everything is still pretty solid and bullish. So back to Rocket Scooter. Call my name on the space. So all signs are good. I'm going to turn off MHP so I can auto scale in the middle. looks good. So right now, it's going to be caution until PMIs come out. We should be careful on this. All right. Good morning, guys. What's up? All right. You know how it is. I don't trade super long into an event, especially when all three of the index levels are moving a little bit differently. Nasdaq's getting that quickie little bump up as Nvidia is pushing up to be a $1 trillion market cap company. Nvidia joins the $1 trillion club. I think that happened on Friday. But yeah, so just keep in mind, watch out, watch for interactions here. If we do tank on PMI to hedge pressure, I'm going to buy the dip and I'm going to trade right inside of here, this little V shape. You guys know how open, blue open is on liquidity map. One of my favorite trades to make on BLU, open, blue open. So it'd be a nice, decent scalp to hit pretty heavy. So when it happens, QQQ hits, it's okay. So this little scalp on the open, QQQ hits impact red line. We know how that goes. So that is that little quick run pre PMI. 5 minutes till the news. So take it easy. It'll be a smaller move and then a bigger move. So keep. Nah, they've always been editable. There's a way you can lock it somewhere, and I can't remember where on the platform. There's a lock feature. Somebody might be able to. No. All right. Why would your 1 minute candle be different than yours? Maybe they zoom in. They should be the same. Okay, let me do a. Let me see if that's where we need it. So basically, I'm waiting for a dip to go long on. It'd be very amateurish of me to chase any long right now going into obviously 3-star news events. I mean, these things are pretty. I'm gonna preliminarily. Don't want to get too far ahead of myself. We're going to particularly look for, signs. The market can perceive the PMI numbers are going to come in bad. They always do. We've been laying off essential employees, so what you're going to see is a lot of future slowdowns when it comes to the new orders numbers. It's always going to be something that you take a look at. General business activity, and of course, the employment situation. So as we always have that analysis of this, and this is for, obviously, you know, this is the non-manufacturing. It's going to give us a clear visibility. Be here. Oh, so, okay, it'll be here. Okay. I'm just going to try to pinpoint upward breakout yellow line targets. Boy, I'm just... Yep, that one as well. Okay, this is me, I'm preparing, so just get ready for this. 5 minutes, pretty much, until the news comes out. Let's go and wait for that. Every morning you have to always make sure that you're prepared and know what's coming up for the day. Don't just treat every trading day like it's a time to start figuring out where to get in, where to get out. Very small areas. So then make sure that you know that something's coming up. So if you're not aware of your news events every day or your calendar events, this is something that... Oh, the music's a little loud. Hold on. Right here, there we go. I turned VSync on my computers and there's this known bug in Thinkorswim where it just doesn't like with that, or G-Sync, sorry, doesn't like working with G-Sync. Okay, so in general, we're using illiquidity pivots during moments of catalyst or outside of VD bands when it comes back around as being potential retracement areas to pull back to. These two levels I drew are going to be impact and run length, we call these. This is a key pivot. Clearly today to the downside, there's a level there, and we're also going to measure yellow lines from that bottom spot. And we got 4 minutes. This is just me prepping. Always gonna do your prep work. Future's trucking along pretty good. Rocket scooter. So right now we are past the halfway point of development of the DOM, the connection, the orders, everything. So we are maybe 2 weeks away from having something to play with. At least me having something to play with to test it out. Okay. Perfect. Okay. So from here, I'm going to measure one more thing. Is the news at 10? Services comes out at the 45, and then non-manufacturing comes out at the hour. Get two of these in the way. Okay, good. All right, last step is I'm going to delete that little... So when you have G-Sync on, it really just... Thinkorswim hates it. It's really slow. Your mouse gets slow. Okay, we're good. Okay, perfect. I got that. Those lines right here. Good deal. Good deal. So nothing really in the way. We have downward targets, upward targets. So today, illiquidity. If we get some volatility come through, we've got a 4270, 4320 run. At least that span. Nasdaq's still pushing higher, especially beyond this impact line. I'm gonna remove that. Okay, back to Rocket Scooter. Sorry. Here. Okay, good deal. All right, so looking at the data, all things look great. No problems here. Resilience is good, DD is good. So you're drawing everything out. I mean, it's pretty cut and dry day. Make sure I get my gap fills. So I can have those That was achieved on Friday. Okay, good deal. I think we have drawn all the other ones that we have. Check. Curious if this one was one or not. Passed them the 4,300 on ES. That's incredible. Okay. All right, one more minute. I'll have the numbers come through. I'll give you guys a report when that happens. Okay, let's double check this and make sure that this isn't open. I'm doing that. Okay, 45s come out, services PMI come through. 54.9 on a 55.1 mark. A slight, hold on, wait a minute. Slight miss. Just read that real quick. Services PMI. Just the it's a slight miss, but still getting better. So it covers transport, communication, financial, business, and personal services competing in IT, hotels, restaurants. It's very big for the NASDAQ. Obviously, you have your communication sector is one of the bigger sectors in NASDAQ. And of course, competing in IT, things like that. It's been kind of slight improvement. Obviously, you'd expect slight improvement with the performance we've seen in that sector or those sectors in the NASDAQ. So not a terrible thing, but that's not the big mover today. You see the non-manufacturing comes out in 13 minutes, so pay attention on that one. Okay, what was I trying to do? Oh, gaps. You can find some upside targets just by marking my gaps. That's something we do every morning while we're waiting for the events to clear through. Yeah, you're correct. Robbie, I would do that every time. That's what I normally do. I long off of the open if res is above 0. And all signs are great. You know, great non-irrational markets. Things are looking good. Obviously, it's a long out the open. But the idea that we have an event coming through in just a little bit, it's just a gamble until that happens. So longing, and if on the technical side of things, if I were to long, I would definitely be getting out of it right now. Or at least severely trimming it, because I don't want to hold something into an event that could push the market in any direction, right? Right. So when typically res is calculated before, always res is calculated before DD. DD comes in about a minute after, once we run all the stocks. So if you have res, you know, even though DD supersedes resilience, I usually get it on resilience, and if DD comes in conflicting with that, I will modify my position. But resilience is the first data point you do get. Even though it's not the highest of the priorities, you're right. Okay, let's load up. I'm just trying to make sure I got all my gaps correctly identified. Okay. I think we're good. Okay, so just gonna wait. So I can't just looking a little weird, yeah. This is really odd for the data, yeah. A rocket shooter has, it doesn't, the candle data is, there's multiple suppliers of exchange data. There's multiple exchanges in the United States. So it could just be a function of the single exchange we're looking at. Hold on 1 second. Like that could just be the orders there. It could be. That is a really odd look for that, but it could just be our platform's data feed. Let me double check, like a secondary data feed. Oh no, it's doing that in all the exchanges. Oh wow, yeah, it is. That is across the board. But sometimes we'll have, like, all the exchanges pretty much reflect each other, but sometimes you might just have something in one exchange you don't see in the others, but we see them all here. It's that way in other platforms too. Yeah, like platforms like Thinkorswim will provide data for all exchanges. That's one good thing about Thinkorswim. It is. Hold on. Yeah. Obviously, the services PMI came in as a slight miss, but improving over the months. But in reality, in 8-9 minutes is where we got the big dog coming out, the ISM non-manufacturing PMI, which is the data point that is going to be forecasting the actual effects of the recession and destimulated lending markets. So, like, ideally, if commerce is down because unemployment's been up, people have been getting laid off, can't get their jobs back, and jolts are coming down. It's a clear state of what a recession actually is, even though the market is screaming bullish right now. In general, as we see the positional shift to bull market kind of ends late July for S&P, early August for the NASDAQ, as that's the stronger push. In general, the bearish fundamentals are still creeping in. The PMI is going to kind of reflect that. Obviously, you get things like new orders, right? You can see if companies that are buying wholesale goods and things like that, or stockpiling inventory because people aren't buying the stuff, you're going to see new orders coming down, which is forecasting, a slowing down in commerce and of course slowing down the economy. And this, the PMI numbers really do have good, almost like forward guidance into what's going to happen in the economy, maybe months out. So obviously Wall Street doesn't immediately reflect, oh my God, it's terrible news, let's sell everything off. But it can have one of those knee-jerk red days, as obviously like today. Trading into such an important thing after an exhaustion run on Friday's expiration would just be too aggressive for me. What I do want to see is the market dip to some key levels and just me jump right back in. Nothing in my blood tells me to want to fade this bull market whatsoever. All signs are strong across the board. There's like 4 different things we look at on the data side, and everything's pointing up. There's nothing that's pointing like this is going to end. So days like this, when a good news event comes out, I'm always waiting for a good dip to buy it. All things look great. Tech still looks strong. And of course, this being the non-manufacturing, that's going to have it's going to have a lot of volatility coming with it. So I'm just gonna wait and get a dip, and basically I'm still in that buy the dip mode through the summer, and that's probably not going to change anytime soon, especially if the Fed is committing to slowing down rates, right, to zero rate hike and possibly holding that for the year. That's a very big up, at least on the Wall Street side, for having a little bit more faith in, I guess, the liquidity of the market, because they know that other traders will step in and bet alongside the Fed. So that's my whole take on the thing. But 7 minutes, news comes out, and probably see if I get a dip to hedge pressure on anything, tech, SPY. I'm looking at the same stuff I've been looking at for the last 3 or 4 months, the same sectors, tech, and then of course with energy. Today we had OPEC's cutting rates. This is one thing I want to talk about on that as well. I traded oil for a very long time. OPEC will usually raise and cut rates, to throttle production to create a different price in oil, because that is really the currency of many of the OPEC countries. So it's essentially they're matching inflation. If inflation's up, they're always going to throttle production just to bring prices up to match inflation. It's not necessarily a sign of bullishness in the long haul, it's just a sign of reflecting inflation. So with that being said, energy stocks, like you said this morning, are probably going to be strong, reflecting on that production cut. But other than that, all the market's going up. So it's really just which sector do you think has the most travel to go this summer? And I'm on the boat that we're probably going to see, some of the things that are pushed down the hardest, the ones that are going to move the most, as tech is kind of reaching its peak right now, right? So as that slows down, I'll be looking for other things to get in on. And while I'm talking, just kind of waiting, and we'll see. I'll try back in about 5 or 6 minutes and see what we get. But that's about it. What's up?
You said that you look at 4 different things, and those indicators tell you, okay, for sure the market's going up. I want to wait for the news to settle, then I'll find a position. But those 4 things that you look at, do you ever see those 4 things sort of flip on their head like immediately? Like if, for instance, some sort of negative news comes out.
What's up, guys?
Could those 4 things change in
right, guys. Come out. A couple misses here. All right. All right, guys. Data's out. Let's go. Ooh, there's that hedge pressure. Okay, let's take a look at it. Resilience has dropped massively. We're still positive. We're still good. Chit-chatting. All right, let's see what I can find. All right, let me look at this. I know my spidey sense is like, don't deal. I mean, everything looks good. Nothing looks bad. I don't know. Something just feels off. Like this kind of algorithmic hold the price was kind of, I don't know. I'm a little skeptical. Aren't y'all skeptical too right now? Feels weird. Although the data looks great, it does feel weird. I have a weird feeling. I feel like I feel like I should do nothing today. What do y'all think? I really don't know it. What do y'all think? All right, guys, I'm back. So let's read the data that's come through. Factory orders, 0.4 and a 1.1. That's a huge miss, as we said. You know, these things are coming down. The non-manufactured PMI coming in at 50.3 and a 51.8. Same thing as well. This was the scalp from blue to open, blue, open. Obviously, I did miss that because I was talking on a space. But open, blue, open is the nice scalp to take. My spidey senses just don't feel right. And I don't know why. What do y'all think? I know, I just don't like it. Let's read the data. CV employment trends. All the data looks good, though, to take along from here. All data looks good. All looks good. Looks good. Okay, let's draw this out. The only thing that's really got me alarmed is the Russell. So I feel like people are gonna, I don't know if they're gonna succeed, but people are gonna try to sell this decent news. I mean this decent news. They're gonna try to sell this today. Russell does have some, I'm trying to find lower lows for the morning. So all things, now again, there's no data for me to want to short or short off of something. Nothing's really giving me any scary short signals, but the market does have the ability to pull back and find some lows, and I kind of want to wait that out. So I'm not going to really do anything. Factory orders, 0.4 and a 1.1. Let's read the data real quick. The boring stuff. Let's go. Factory orders. All right, we've been declining on this as the months have gone by. 55, 51, 51, 53. So in general, you know, the PMI is a report. It's the non-manufacturing sector. It's a report. They obviously survey a bunch of people in the sector. There's all a bunch of categories that you look for. You look for the business activity that's adjusted seasonally, new orders, employment, and supplier delivery. So all parts of logistical chain of non-manufacturing companies. And you can see that number came in as a miss. Number one, of course, in a recession, you're going to see these things coming down. The employment number, also a miss. So obviously, you know, jolts are coming down, and so therefore this sector is reflecting that sector, or this non-manufacturing sectors are really reflecting that is a big part of who's getting laid off. The general business activity generally down as well compared to the forecasts. So it's just showing the slowdown, and this is pretty what you're going to want to see. New orders is more of the forward guidance, and you can see that this number's just been getting dunked. I mean, this is just really bad. They're expecting growth in new orders, obviously, because companies' stocks are going up, and these are forecasts or estimates, and we're obviously coming in ways and miss on those. So this is showing it the future. Factory orders, right? You're not getting pallets of goods. I guess this is non-manufacturing, but you're getting like pallets of goods, you know, to your business. It means that people aren't buying the goods you already have there. So your new orders are down. That's obviously showing that retail sales should be down, and obviously that's not so great for the stocks of companies at the end of that chain in general. But I think most of this is effectively priced in. And the last part, transportation. Transportation. So is everything minus transportation also down. Expected a growth, and we actually got a decline. So I think that today could be a catalytic day that the market comes down. My spidey senses were right. I'm not necessarily jumping in on this, even though the data looks good. I do not like it. And so when you have a catalyst or an event, you have to be very careful trading, and obviously like just the feel, right? This felt weird. That quick pop felt weird too. I don't know. It'd be nice to have just like a nice little red day today to follow up with a green day tomorrow, which is good. I'm supposed to go get coffee today anyway, so might as well just take it easy. A little blue said weird day, still took a long. I love it. Let's do monthly map real quick. DD point. Yeah, DD is great. It's like we're gonna end up in the bull zone when we close. No way around that. So it's not gonna collapse the market today. and I just don't like it. You know what I'm saying? Doesn't it just feel a little off? Well, let's analyze the monthly map and see that in the middle of July, as we're seeing that pivot again. SPY is still anchored, right? Still same spot. Nothing's really changed from Friday to Monday. This is one thing that is different, though. September. August, September. You're going to see kind of a ramp up. This is new. This has changed. So you see that strengthening bullishness in Nasdaq all the way through September. Actually, we're gonna see some more bearish play as we start to head into the fall, quarter three. Obviously, going to see bears and bulls both betting pretty hard. It's going to be interesting to see that the market's becoming increasingly liquid near the top, which is a consolidating pattern. So obviously what's going to happen is the Nasdaq is likely to rally through the summer and then just hold. It's not going to rally and sell off. This is liquidity right here. So it's going to hold for like a month, and then likely volatility comes almost as late as October. Imagine this Nasdaq rallying through October. This is what the monthly map is telling me. Right? So as you see, bull side is strengthening, bear side weakening, bull side strengthening, bear side weakening. So longs and short covering, double buying. And then shorts entering, longs entering heavier. So this liquidity trap right here, market is going to hang like from August until the end of September. Looks like our spidey sense was right today about the markets. That maybe the increased delivery. All right, let's look at this booty market. Spidey sense today, just maybe just let today relax. I think this is a good day for everybody to take off and just chill. Okay, here's the trade I'm gonna do today. Y'all know I made this play a million times. So y'all can guess what I'm gonna do. Here to here, DD long scalp. That's it. So today, market's probably gonna do this. That's about it. So we probably will take a long scalp off of bear to bull. Y'all know that trade, right? I've done that trade a bajillion times. Y'all know the DD long scalp, right? You have a swing like this, it spends like 2 hours. Take out liquidity and fair value. Yeah, I agree. This trade is scary. It's like in the middle of a red candle, it's likely to get like a big green V to test. Like DD being positive enough, you have to tell yourself, now obviously this is a long entry point. I'm just being kind of wussy about it with resilience declining. So with resilience strong enough, it does show there's pressure there. With DD being bullish, it means that it's going to want to connect with this and likely close above it. So any downside inside of here is likely at least a snapback at minimum. So we either like, you know, do that or that. But ideally, this leg is prominent in this kind of trade. Positive DD when you touch bear zone. Right. Yeah, it's a good scalp. I think we did it a couple of days ago. on our end that we call the market irrational from this point. Not that the Russell really has a lot of power to drag everything down. Typically the S&P, stays the fort despite the Russell. It has been all year. The Russell at about 1800, 1801, give or take, is a key threshold where you'll find some instability and volatility can come back. So just keep an eyeball on that 1801 level on RTY futures today. That's a from month June contract, and I appreciate you bringing that up too, because that's something when anybody trading. I heard this morning someone said Dow as well. Whenever you're trading, you should maintain visibility on the S&P and the Russell at all times. Nasdaq is kind of a novelty. This tech is the hot topic, but at least the S&P and Russell show diversified baskets of big and small cap stocks. So you really get to see Wall Street's appetite for stocks in general by always monitoring this too. So if you're looking at any stock, anything you trade, make sure you always just have side charts where you're watching this too, because it, as you see, it very clearly tells a picture. People are more comfortable buying stable blue chips than they are riskier, smaller caps. So it doesn't really show. It just kind of shows what people's appetite is, right? So you kind of feel out the market a little better. But yeah, visibility on the Russell just is always such an important thing. So I'm glad you watch it.
No, for sure, man. I do want to point out too. If you look at NQ on the 5 minute, you have a flag form.
You guys know me.
Price action, but
So pricing out a little bit more of this. Rules are this. This is all great signs.
right between that 14603 to 14620 area.
So we open above bull zone, it's more likely to close. Here, open above hedge pressure, more likely to close above hedge pressure than close below. DD being strong enough, we're likely to have at least a bounce from bear zone to bull zone. But it's a risky trade because clearly it's trading in a hedge pressure break. There are rules we have against that. So because of that, with those lights being red, it's a trade very, very, very small from here to here. DD greater than 0.6. We're going to have an SPY hedge break when that happens. Like I said, likely to close above here and close above there. Res is going to pivot around these two. Res is positive, so at least at this point, that move is still prominent. So as you see, like all of these possible legs, I don't disagree with something like that. This would be very abnormal. So obviously it'd be very easy for me to see where I'm wrong. If you hit 427 and don't bounce there, if it hits 427 and plays around like that, I'm just gonna, have a nice tight stop, 426.5, which makes it a 2-to-1 trade, right? So I want it to bounce very quick. The DD is very strong, 92%, right? Yeah, it's very possible it could support from here. All signs say that it should. All signs say that it should. But what I do is, especially when there's an event day like this, if you're not getting a really solid bounce on hedge pressure. Now, again, risk management's good. So if you were to take my opinion, right, with a grain of salt, if I were to want to long this in one trade, I know that I can either long on the BLU to some target. I can also long for the scalp from here to here. I know that this long is not irrational. It's a green light. This long is irrational. It's a red light. So, I also know whenever I stage into a trade, I'm going to want to stage in heavier. Ooh. What the heck did I just do? I must have hit some hotkey that minimized my whole screen. Hold on. Oops. That's funny. Okay, back to where I was drawing. Right, so I know that this trade is going to be irrational and this one's not. And irrational, I always have to trade very small anyways. Very, very, very small. which means to be able to stage in heavier, by default, that trade also must be small. So like, I'm not going to trade 1 mini because things are green and then 2 micros because things are red. It's not going to adjust my cost basis. So since I'm anticipating a possibility of that off an event, just because, I would be by default also trading my first entry small. So I would put in like 1 to 2 micros here, and maybe 3 to 4 more micros here. Right, so at least I can get a cost basis there, and the overall position is very small. Do y'all follow that mentality? So it affects my first choice. And why do I think that this is possible? It's just a feel. There's nothing telling me that's going to happen. But the idea that I know that this trade is likely after a news event to happen with Russell kind of collapsing, I'm going to be very cautious and anticipate that this might be possible. So if I scalp from here to here, this entry must be bigger than that entry so that my cost basis is in the bottom half of that range. And that's what we're looking for. So I would naturally, if it were to support here anyways, I would naturally be in just a small position by default. Okay, it's this. I'm going to plan out what I think the worst case scenario is going to be for the trade. The last entry I'm going to get on the long side is my worst case scenario. I'm going to long from here to there. Because it's a hedge break, it's irrational. So we're going to have red light. But say on the bull long up, it's like trading down and trading down, trading down. I'm like, ooh, I want a long there. Normally, I'd be putting in my normal position. All lights are green. But if I have a feeling that it could break hedge before it bounces back up, then I have a feeling we're going to be irrational. So I have a feeling that this trade is going to be red, and therefore I'd have to trade it very small. So because I'm anticipating a possible place where I'd have to trade small, going with my other rule that when I enter a position and I enter again, has to be a double or more of the size. So if I buy 1, I might buy 3 more down here to get a really solid cost basis managed, like a cost basis reduction on the trade. So I buy here, then I buy there as well. Because if I buy here, it has to be very, very small, and I anticipate that's a possibility. If I were to just long up the bull long up from here, I'm not going in full port or big position. I'm already trading small, even though lights are green. I'm anticipating an irrational market for my second entry. Therefore, my first entry, while rational, still needs to be small, or else I won't get a cost basis adjustment. The example is if I bought 1 mini here, down here, I'm not going to trade 3 minis. It's irrational. I'm not going to go heavier in a bigger position when it's red. So therefore, my first entry is going to already be very small. And why? There's no sign. There's nothing in the data telling me we're going to fall. Everything's telling me we're going to support here. So it's not a terrible long to get in on. So therefore, because we're selling off of an event, events can break hedge pressure. We've already had a cautionary hedge pressure break. I'm already going to be trading small. I was explaining, as Ben has said, that's how I'm explaining how it costs in. So normally in a BLU, pretend that my normal position's 1 mini. I'd be hitting it with 1 mini right now. But because I know this leg is likely, and that's the leg I really want to capitalize on, an event can quickly drop the market and bring it back. Then I want to make sure that this trade has to be a bigger size than this trade. So this trade's supposed to be small already because it's red. That means my first entry will be small. So somebody's question has said, Matt, is it possible it could support from here on? Yes. But it doesn't mean that the trade I'd be in right now would be anything with a lot of risk, even though all the lights are green. And again, when you have a feel that things might get bad, like never ignore your feel. The proper technical approach right now is to long at 428. But this is a thought process that says, but let me long small, right? This is not let me jump in with my normal size position. So correctly speaking, like I would say that if my normal size was 1 mini, then my reduced size would be 1 micro. So I put 1 micro here, and I'd probably grab 3 more micros here, and then trade it right back to there for profit and close out the whole thing. So it's an adjustment to my rational entry being small rather than normal. because I have a feeling we might dip. So anytime you feel off or your confidence is shaken, you just adjust the size of your position. Do we all understand that? That's like rule number 1 in our risk management class. Your risk scales with your confidence. If my confidence is small, it's not hitting hedge pressure and bouncing very quick. Russell's pulling back, potential hedge break. While it is appropriate to long at 428, I would still be barely putting anything on it at all. And plus, since there's not a lot of travel inside of here, this resilience, obviously, there's not really a really big gauge of where it could go. So I'm also not shorting it as well. So ideally, I'd like to see this. And so because, the range is likely not that big, I don't want to be making decisions in the middle either. I want to span the range as low as I can, just to get as much R&R on the trade as possible. No trades whatsoever. You can see on my screen, I'm not touching this at all. None of my account. Nothing has risk on the table yet. Res numbers are still solid. NASDAQ is pretty solid. Keith Miller says, how do you feel about fib levels? There's no magic to fib levels. Sometimes it balances, sometimes it doesn't. I really think that numbers like that don't really have much sophisticated meaning other than it's self-fulfilling. If people trade there because they think it'll work, then it'll create activity there, but there's nothing magical on the framework of the market. Fibs are with a grain of salt. Now, if you ask me personally, I try to be open-minded to people's analysis, so don't listen to what I'm about to say. I think numbers like that are very useless in a repeatability sense. Like, you can't, on any level you trade off, as long as you repeat your risk management, there's nothing useless, right? If you behave the same way each time, if it hits the level and you have a X amount stop every time, then it's repeatable. You're repeatable, part of the equation. So while I think the numbers themselves have zero effectiveness, almost to the point that they're absolute garbage, doesn't mean you can't use them to trade. You can be a superstar and trade with anything. So I think that the numbers themselves really provide declining effectiveness as years go by. They used to be good a long time ago before computers took over and things got more sophisticated. Traders would self-fulfill them. Liquidity was less, so a few big firms that could have been that firm's strategy first 5 years, and it created activity there, and traders mimicked it. But as variety gets higher and more sophisticated methods really take over, classical TA just falls on its face most of the time. A great question. When it hits it, it's usually very, in all honesty, what you do notice is that if you take like a range, right? Anytime you're looking for buyers and sellers, you can take the quickest path there. Usually markets will test, and if you find sellers, you'll come back half. If you find buyers, you'll go up half. It's more fractal than anything. And then, of course, you'll start to see like that mentality start to show, accumulation at these basic points, 75. And, 23.6 is a fib level. It's really just 25%. 50 is a fib level. It's really just 50%. It really reflects the more fractal nature of, binary search, where you take the quickest path possible to find a number in a set of things. You're trying to find buyers and sellers. The quickest way there is to raise price until you find sellers, and then lower price so you find buyers, and raise price so you find sellers, and then people converge typically in a fractal more than anything, half of a half of a half. But it is random. So the reason that it's random when buyers step in is why I don't put a lot of faith into an actual hard number. But the mechanic of that fractal nature is something that does happen, and just natively, instinctually by all humans and all computers do that. So, but nothing magic about 61.8. Even though fibs are like everywhere, like in nature. You see that sequence and those numbers kind of arise in so many different patterns. The stock market. Yeah, and it's the greatest part about it is you can create simple repeatability around fibs. So like you can create any number in any percent pullback as your support to buy on. As long as you have consistent risk management, then you have consistency with the effect. Which is great. So Res and DD are too strong. I don't see any indicator that at 1 p.m. will be below the opening range. I agree. That's why, like in the morning, I'd like to see us pull way, way, way back and then long right back up, as you had said. How do I pronounce your name? Because I do not. I do not read what your characters are. Monkey King, Wukong, cool. Is that Mandarin? I'm presuming. Monkey King, Wukong. All right, cool deal. I'll call you Wukong. Yes, sir. I agree 100%. Yeah, I think we still stay up here by the end of the day. Numbers are way too strong. That's why I'm like, I want to see the market make an attempt to sell off, and I'll just gobble it right back up. Being that this is the middle of the range, this is the middle of yesterday's close, this is right in between open and close. Ideally, you know, I want to stretch further down from here. With everything all compacted right here, it's just too sensitive. Too potential to be too sensitive to the noise. And, pressure. It's right on hedge pressure. So a quick dip, quick red. I'd gobble it right back up and close out. I like these scalp days like that. Resilience work for oil and gold, or do you just look at liquidity map? So resilience is like a sum of things in a basket. So resilience for the S&P is a nature of all the 500 stocks, or all the 500 companies in the S&P. So like oil is just one thing that's not a basket of things. So resilience being like an aggregate, which like a sum of stuff. You really can't make a resilience out of oil. Now you can make a resilience out of the oil sector, like the XLE, for instance, the spider. And you can see how far the spider's deviated from the sum of the stocks. Two independent traded vehicles. One is a basket of things that trade, and one is an instrument that reflects that basket that trades. And when they go in different directions, it's resilience. It's like showing that like something's supposed to track the sum of something else. So straight up, like oil can't have resilience, but you can put that into like an ETF that tracks oil companies or any of those things. Like you can create one for the XLE, you could probably create one for the XOP, which is the oil exploration and production, like the upstream sectors, drilling and such. And then add up all the companies inside of that. And so gold, you probably have like, there's some ETFs for miners and ETF for, we can compare the ETF to the companies in it. Yeah, you'd have to like, so USO, you wouldn't be able to make something for USO. USO is just a commodity pool that owns oil futures. So it doesn't own, USO doesn't contain like oil stocks in its basket. Right? So you wouldn't be able to like compare USO to anything because the USO wouldn't be deviating from anything other than the oil contracts themselves, which it can, but then you have no aggregate that you can kind of create a stronger like a stronger relationship. Yeah. Y'all know the trade I want to take. I'm going to call it a day. We'll come back maybe in a little bit on a Zoom call. Hold on. do Zoom call probably about 2 Eastern, give or take. I'll have an announcement in chat. Like I said, today, market has no sign it's coming down. Even if I were longing at hedge for sure, it still would be very small. And we're confined to this range today. I want to get a nice little dip. And if it continues to move higher, it's just another day I missed. I had a 10K week last week in the 10K challenge account, which is great. 100% win rate last week too. I tweeted the statement, so it was a pretty solid week. I'm in no hurry to give any of that back. I'm gonna go take it easy today, get some work done. Jam to some watermelon sugar. You know how it goes. We'll see y'all later. Thanks for tuning in. We'll call it. You guys, I know, thanks for being a part of the Rocket Scooter family. The fastest growing trading entities on the planet for sure. Massive amount of you guys have just jumped in and started learning our new techniques. I'm glad that we can provide something of substance and something really new to the retail side. And we thank you all for being loyal, valuable customers. Rocket Scooter. All of our tools look at positional risk, as you know. We show you where the positions are, despite what the chatter of Wall Street is. Bullish or bearish, people believe this, believe that. Wall Street will tell you where they're positioned. That's all you really need to know. They've got more information than you do. They've got the inside information that you don't. And you can use all that information because they tell you where they're positioned. And they're positioning somewhere, a lot of money. There's probably a good reason for them to do so. Trust that they're doing their homework, because they've been winning in the stock market hundreds of years more than you have. So institutional positions are the future, literally future. Options tell you where people want to long and short in the future. Technical analysis is a time machine. When you aim for 1985, you end up in 1955. Don't think so far back. Look into the